Next guest says recent data points do not point to an imminent recession and that long-term investors should lean into the weakness at these levels. Edward Jones senior investment strategist Mona Mahajan joins us now. So you think the market's gotten a little too pessimistic, Mona?
Yeah, look, coming into the jobs report, we certainly we're looking at a market that through August was up 18%. So could we have been due for a bit of a pullback or correction? Absolutely. And last week we did get just that. The S&P 500 was down about 4.2%. Really, we saw a string of weaker than expected jobs data, starting with job openings coming in lower than expected, ADP report coming in lower than expected. And then, of course, the big one at the end of the week was the non-farm payrolls report, which came in lower than expected. And the revisions to the downside were certainly something that spooked the market as well. Now, of course, to balance that, we did get the unemployment rate come down a tick, 4.3 to 4.2%. And the 144,000 jobs that were added, yes, we are weakening. But typically when you're in a recession, you see negative job growth. And also this is more in line with what we're seeing in the average, maybe in the 10 years prior to the pandemic, which was about 165,000 jobs on average. So we're certainly in line with that. Now, look, there's no doubt that the economy is cooling, the labor market is cooling, but not collapsing yet. And so in this backdrop where we could still see a soft landing, the Fed is cutting and inflation is moderating, not a bad backdrop for markets broadly.
No, I agree with you. I think if there was real stress out there, you would at least see the number of Americans filing for unemployment claims go up. And on a week-to-week basis, I mean, they fell last week, and they continue to be low relative to other periods of economic hardship. So another good sort of real-time indicator. I guess I'm wondering, though, Mona, then why wouldn't the big cap stocks, NVIDIA, the ones that are growing so much, be more safe haven, especially when yields are going lower and when there are concerns about growth?
Yeah, look, I think that theme of market leadership broadening is starting to play it out. And I know we've heard that multiple times, probably just even this morning, but it does feel like tech has come off the boil. It was the leadership, not only in the first half of this year, but really through 2023 as well. But, valuations may have gotten extended, even though earnings growth is keeping up, we think, in that sector. And by the way, this promise of AI, we still think it has to deliver, but some of the revenues haven't yet come through in a lot of the sectors that we are hoping to see. So generally speaking, we think some of this is just, where can we, historically when the Fed cuts rates, we do tend to get valuation expansion. And so where can we see that valuation expansion? Is it in the sectors that have already been performing, or will we start to see the sectors that have really lagged and can do well in a low rate environment, a cyclically, hopefully upturning environment down the road? Those are the sectors that we're looking at. So think about the cyclicals and even value parts of the market to really play some catch up.
And as for multiples, I mean, we were just talking with Mike about it, even for the equal weighted S&P, 17 sounds reasonable in some ways, but as he pointed out, that tends to be towards the higher end for at least over the last 15 years for that part of the market.
Yeah, it's a fair point. But look, we're at the highs for the Fed funds rate of 5.25% to 5.5%. We're probably headed towards at least a multi-year rate cutting cycle through this year and next year, and headed towards maybe a 3.5% Fed funds rate, which does put some upward momentum in valuations. And so could we see an equal weight get above that 17 multiple? Possibly. But also keep in mind, to the earnings growth point earlier as well, this year, Q3 and Q4 actually were revised lower, and we're still about a 10% earnings growth rate. Double digits next year is possible as well, especially if, we are seeing some, if the inflation is falling and the Fed is cutting rates. Consumer and the economy could see some reacceleration there in that environment. And so that would be a good one as well for consumer cyclical parts of the market. So valuation expansion, we think, can continue to be a tailwind for especially that equal weight part of the market.